Hey everyone, welcome back to Corporate Decoder. Today, LRHC just filed a Series D convertible preferred financing, and I am seeing key details about how they are raising money right now. Quick note, this is not financial advice, just my take on public filings for educational purposes. Rosa Holdings is bringing in new investment through preferred stock, and it looks like they are setting up for their next steps, but there is a catch. Alright, let's dive into this filing from Rosa Holdings Corp. It is a Form 8K, which means a company is reporting a major event that shareholders need to know about. And this one is all about them getting new funding. The main story here is a Securities Purchase Agreement, or SPA for short. Essentially, Rosa Holdings has agreed to sell a specific type of stock called Series D Convertible Preferred Stock to an investor. They're calling this investor the investor, and the deal is for up to 500 shares. Each share is priced at $1,000. Right now, on May 27, 2026, they are closing on 250 of these shares, bringing in $250,000. The remaining 250 shares can be issued later at the company's option, specifically after they file their annual report for 2025. This means they could get another $250,000, bringing the total possible from this deal to $500,000. This is a pretty common way for companies, especially smaller ones, to get cash infusions without immediately diluting existing common shareholders too much. Now, let's talk about this Series D preferred stock itself. It is important to understand what makes it preferred. First off, it doesn't pay any dividends, meaning no regular income payments to the holder. That is usually a downside compared to some other types of investments. When it comes to voting, this stock generally doesn't give the holder a say in company matters. However, there are specific situations where the Series D holders do get voting rights. These are usually when the company plans to do something that could negatively affect the rights and benefits of this preferred stock. Think about changing the company's basic rules, increasing the number of preferred shares, creating new types of stock that rank higher, or buying back common stock in ways that could hurt the preferred stockholders. It is a way to protect their investment. The really interesting part is the conversion, right? Holders of this Series D preferred stock can convert their preferred shares into the company's common stock. This is how things can get a bit more complicated and potentially dilutive for current common shareholders. The conversion amount is basically the value of the preferred stock plus any other amounts owed. This gets divided by a conversion price to figure out how many common shares they get. The conversion price can be a fixed amount, $1.58 in this case, but there is also an alternate conversion price. This alternate price can be triggered, and it is set at the lowest of a few things, including the floor price, which is protected against stock splits and similar events. And importantly, 90% of the lowest average trading price of the common stock over a 10-day period leading up to the conversion. Notice this is a pretty standard feature in convertible preferred deals, often designed to give the investor a better price if the common stock has fallen. And here is a kicker. If the investor chooses to convert at this alternate conversion price, the amount they convert is actually multiplied. If it is tied to a change of control event, it is a 105% multiplier. If it is for any other reason, it is a 125% multiplier. This means for every dollar of preferred stock they convert at the alternate price, they'll effectively convert an additional 25 cents worth of value, but in the form of more common shares. This is a significant upside for the investor. There is also a cap. A holder can't convert their preferred stock if it would make them own more than 9.99% of the company's common stock. This is a common anti-takeover and dilution control measure. Rosa Holdings does have the right to redeem these shares, meaning they can buy them back. They can do this for all the outstanding Series D preferred stock, not just a portion. The price they'll pay is the greater of either the original conversion amount or a price calculated based on the common stock's highest closing price over the period before they announce the redemption. This gives the company an option to get out of this obligation if the common stock price performs exceptionally well, though it could be costly for them. The filing also states that this sale of Series D preferred stock was done without registering it with the SEC, using an exemption called Rule 506B under Regulation D. This is common for private placements to accredited investors. And as part of setting up this new stock class, the company filed a Certificate of Designation with the state of Nevada. This document officially lays out all the terms and rights of the Series D convertible preferred stock, which we just discussed. Let's look at the exhibits. We have the Certificate of Designation, the form of the Securities Purchase Agreement, and the interactive data file. Exhibit 3.1 is the Certificate of Designation of Series D convertible preferred stock. This is the official document detailing the terms of the preferred stock. Exhibit 10.1 is the form of the Securities Purchase Agreement itself, the contract between Rosa Holdings and the investor. And Exhibit 104 is the cover page interactive data file, which is standard for filings. Now, looking at this from a broader perspective, Rosa Holdings is a company in the real estate services sector with a market cap around $1 million and about 39 employees. Recent news shows they received deficiency notifications from Nasdaq for late filings, which is concerning. This financing, bringing in potentially up to $500,000, seems like a move to shore up their financial position and perhaps address those filing issues. The structure of this financing, with a convertible preferred stock component and potential for a higher conversion price multiplier, suggests the company is trying to attract capital while offering significant upside to the investor if the common stock performs well. However, it also carries substantial dilution risk for existing common shareholders if the stock price doesn't rise enough to make conversion at the 9.99% cap unattractive. Historically, companies that rely on these types of financing structures often do so when they need immediate cash, but may also face challenges in accessing more traditional forms of debt or equity. Companies like Kodak, which underwent a 1-for-20 reverse split in 2021, and later Sears, saw their stock prices often continue to decline after such events, with about half of micro cap companies ending up delisted following reverse splits. While this isn't a reverse split, it is a similar signal of a company seeking capital in potentially challenging circumstances. The key risk I am watching is how this preferred stock conversion plays out. If the company's common stock price doesn't significantly increase, the conversion terms, especially the multiplier, could lead to a substantial dilution. What I am actually looking for is a clear path to profitability and consistent revenue growth that can outpace potential dilution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.